Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Merrit Strunk, who's the founder of Momentum Financial Services, and we'll be discussing challenges in planning a successful retirement. Merrit, welcome back to the program.
Mike, thank you so much for having me back. I'm so excited to be here again.
Yeah, I really like your perspectives on helping people clearly understand options and being that educator and advocate for the clients that you work with. So we're talking about planning a successful retirement. So get us started with some of the challenges that you see people facing that you then begin helping them clarify.
Yeah, great setup there, Mike. And I tell you what, I would think that most people would agree right now. It's super, super challenging in this financial environment that we find ourselves in. I mean, some people may say this is the most challenging we've seen things in 50 years in terms of getting, some perspective on the market as it's going through different things that it's doing, people getting ready for retirement and things they have to think about. And, I want to take this moment to talk about some of those things that are maybe some gotchas, things that people don't think about, common misperceptions, challenges in retirement planning. And it happens over and over and over again. It's just, some of those things you've got to be prepared for. And I'll start the ball rolling here. And we see it all the time, folks who are preparing for retirement, got $1 million 401k. And they're looking forward to retirement coming up in, maybe a year. And the problem is many times people think that a portfolio allocation, as they're not yet retired, is a set it and forget it type of thing. And it's really not. It's a huge mistake. So please don't do this. If you're listening to the podcast, please don't do this. And we encourage everyone to inspect what they expect about their retirement future. So hope is not a strategy. That does not pay off. We can help you make sure that your portfolio is managed properly. And we want your money to be working as hard for you as you've worked for it. So
Merrit, if you're saying that set it and forget it is a mistake, so obviously that means we should be checking and having little updates, whether it's annually, quarterly. What is the difference in your recommendation for checking the validity of the allocations before retirement versus during and after retirement? So I would venture to say that 5 years leading up to retirement, we need to be looking for certain things. And then, okay, retirement happens. And now we don't just leave it and set it, forget it. We check still because maybe some of those needs are shifting.
Yeah. And I think you're speaking wisdom here. And I think that when it comes to money, who is it? Ronald Reagan said something like, trust, but verify.
Yes.
That as things move along in our world and our country and the markets and so on, it's kind of that deal. You have to go back. You own it. It's your money. And I know that if you're listening to this, you totally agree to that. But what happens is people go, oh, okay, I'm picking this in my 401k, or I'm picking this in my IRA. And they just let it ride. And unfortunately, many people don't even have a clue. If I was to say the words tactical portfolio management, what they have in complete opposite of that would be something more like a passive allocation strategy, set it and forget it. And it's not that way anymore. How do you know you have a set it and forget it situation in one of your accounts and all of a sudden the market goes down and you are surprised at the amount of money or value you have lost? And it seems to be out of alignment with your risk tolerance. And that's another thing that plays into this in terms of smart inspection, smart review. Is it within my risk tolerance and the way that the assets are allocated in the investment that it holds? Because you can make a case that the closer and closer I get to retirement, the less and less risk I want to take because I may need that money for 30 or 40 more years, right? So
And I
Please
think a
don't
lot of
do,
people
yeah.
feel like the risk tolerance is the only thing that they need to be, looking at. But in reality, what if a certain asset class is now performing better or worse? Or what if a certain investment within that asset class, like, maybe there's a certain annuity that's going to perform better and have a better rate of return and no loss guarantee versus the other type of product. So I think that risk tolerance is a tip of the iceberg, but boy, that I really think that this is a huge thing that people do make the mistake on is I'm good to go, and then you just let it ride and you find out too late that it's hit a floor and you've taken losses you didn't intend.
Yeah. And another one about that, and I like what you had to say about that, but that also tends to come into what's happened in the bond market recently. We're having the worst bond market in the last 40 years. And now let's say your long-term bonds that you purchased are not as good a rate as what the short terms are. So now you have to sell your bonds at a discount. And then once they mature, where do you go? What do you do? And so if you're like a lot of folks in retirement that have something like a 60 bonds or fixed and a 40% equity situation, well, when equities are down and bonds aren't doing well, you're going to feel it. And that conversation, there's other things. I mean, investment choices have changed. There's bond alternatives that have come to reality these days now that the bond's doing so bad. But I think you get back to the point of is that there is no set it and forget it situation. You must know that you or your fiduciary advisor is keeping an eye on things, right? And if the market changes drastically, that they're calling you. I had a situation where there was a fellow who's retiring. Actually, he was already retired, and he has money. His 401k money was still employed where he no longer was, which is a funny way to put that. Yep. And what happens when you go from a Fidelity passive allocation for a 401k and you're retired, and all of a sudden you're looking back and the market's going down. Let's try that again. And so what happens if you have a passive portfolio like that and then the market's going down? Is that Fidelity or that Vanguard portfolio or for mutual funds going to call you up and say, hey, there's some crazy things happening in the market, let's talk about your risk tolerance and your allocation? They're not going to, unfortunately. So that's why you have to stay on top of these things.
Yeah.
Other
thing I was thinking too, the last point, and then let's move on to your next one, because I know that we don't want to belabor the point, but when you're talking about bonds and certain other, investment vehicles, maybe put aside your preconceived notions of, I've always thought that bonds were wonderful, or I've always assumed or heard that annuities are, or life insurance is. Listen objectively to fresh new data, because if a 40-year low tells me that if bonds were always respected as the wonderful, great investment, and now it's a 40-year low, maybe it's time to reassess something. So be open to proven other alternatives, even if you've heard back in the day that they weren't all that great, because maybe some things have changed.
Oh yes, and thank you for that. And what that's just saying is, if you're fishing with old fishing lures on an old paradigm, and fishing has evolved with different knots and different fishing lures and different approaches, then you're living in the past. You're living in specifically related to money. You're living in an older paradigm where things have really changed in the financial industry. Structured notes here. That's another great example. You mentioned maybe annuities as a bond alternative or something else like that, where we're thinking, or certainly certain people who are buying media out there want you to believe, but they're really just marketers. Nothing wrong with that. Billionaire marketers telling you something is bad so that they grow their own business. I got it. But things have definitely changed especially when 401ks for employers are including things like annuities in their choices. Well, there's a whole reason for that. Believe me, the regulatory bodies that look at these things vet them out and go, you know what, a guaranteed income or, safety to principal with a potential market upside is a good thing for future retirees, then, thinking around that has actually changed and enhancements and product enhancements have come. Structured notes is a great example of that. Laddering structured notes as if you would use that as opposed to, say, maybe your old bond ladder. So yes, to your point, things have evolved. Have an open mind, and for financial advisors, for ones that don't bring these things up, who are not having those fiduciary conversations, well, they're just not. They're going the easy route. You have to come from a fiduciary standpoint and say, look, would you allow me the opportunity to at least expose you and educate you on the multitude of vehicles that might be right in your situation, and then prove it out mathematically. Yeah. Thank you, Mike, for that one. Appreciate that.
Yeah. So what's another common mistake or misconception?
Yeah. I think one of the big ones is that Medicare covers long-term care cost. Medicare does not cover long-term care cost. And you may be saying, well, I'm just going to die. Or, I'm just not going to need Medicare. And I'm not going to need long-term care. Studies, I believe it was the Genworth regular study that is out there. Genworth said that, around 70, and don't quote me on this, but around 70% of us, 75% of us are going to need some kind of long-term care. Well, if you don't plan around that, it's extremely expensive. So people have this idea that the government is going to take care of them, and you can't depend on that because it's simply not the case. Now, what about Medicaid? Medicaid will put you up someplace, but you're not going to like it. And basically, you can't have more than $2,000 to your name. You have to be destitute on paper for Medicaid to come and help you out. Now, everybody would prefer to be taken care of at home, right? Come into my house. Let me be comfortable. Take care of me. Look, if you don't plan these things out and plan in retirement for your medical care to go up, and at some point, it's like I say, you're healthy until you're not, you're here until you're not, and you know who you are until you don't. And that has a lot to do with needing skilled care later on in life. And if you're one of those folks who may have cognitive decline later in life, nobody really knows, but dementia is at epidemic rates around the world, and that does take care, and it is progressive. It gets worse and worse. So just, thinking about your retirement planning, that's, as fiduciary financial advisor, we plan around that. We plan around long-term care, especially for the ladies, especially for women. They live longer than men on average.
Statistically, yeah.
Yeah. So having that and knowing that if somebody in the family, one of you needs it, that you're going to be okay. And you've checked that box and you know how that's going to happen. When you don't do that, then you're left later in life trying to figure this out. And it's not, chances are it's just not. Yeah, because, it has a lot to do with money and time. Yeah. And when it comes to money, time, it has a lot to do with everything about money. And if you don't get it right earlier on, you don't overcome that inertia that says, I should probably do my planning. That little voice in your head, future you is telling you should be doing this. And that's procrastination. So that's that little voice inside you saying, hey, you haven't had that conversation that you need to do. You're not asking the right questions. You don't have your plan put together. And you're like, nah, all right, never mind. Well, it's going to come like a freight train later in life. And it may not be that convenient to take it, to address that.
Plenty of times and cases where having more runway ahead of the situation, financially, physically, whatever the case is, you can fix those problems when you have plenty of time because they aren't bigger. But when you give it more time and ignore it, it compounds. And I think that we can apply that statement, that mindset to so many things: finances, spiritual, mental, physical, everything that we can think of. Boy, recognize what could be a need in the future and start making some steps forward. Yeah, really great points.
Another one here is that people think the key to retirement is acquiring a $1 big magic number. And by that number, we're keeping score here. It's dollar number.
Yeah.
So this is a huge misconception regarding your retirement portfolio. It'd be great to get, to a, $1 million, $2 million, $3 million. But honestly, retirement's more about income than it is assets. Assets can be stolen, they can be lost, they can be swindled, they can be divorced, those kind of things. But when you have, income in your retirement, let's just visit the happiest people on earth are people who have a pension. Not all pensions are equal, but the happiest people in retirement and the most successful are people that know that the bills are going to be paid because they have this pension, right? So income and knowing where your income is going to come from and how your lifestyle is going to be funded has a lot to do with the success that you're going to have in your retirement. So it's not just one big asset number in your nest egg. You need to make sure that you're generating retirement income through different tax buckets. So tax diversified buckets. And this is where smart tax portion of our smart financial plan begins to matter. You need to have dependable income stream during retirement without the IRS holding you back too much. You know what I'm saying?
Yeah, because taxes are inevitable, but how can we mitigate them and manage them as much as possible?
Right. And one of those ways, most people know this, is to generate as much tax-free income through a Roth IRA. Mm-hmm. So another one would be generating tax-free income coming from a universal index life policy. I think you had mentioned that before, IUL. And if you're over, in your 40s, 50s, or 60s, you want to figure out how you can get tax-free income, completely tax-free income. And, that's something that we do with our clients. That's something that we do. We spend a lot of time taking a look at that. And how can we get tax-free retirement income in that retirement plan? So super important. I think if all of us were asked, which sign would we like to get up and line up under for the rest of our life, it would be the tax-free sign. We just stand right underneath that and say, yeah, me too. Okay. So another one is, and we run into this all the time, and it's just, people just don't think about these things. And it's about Social Security benefits. And some people think that all seniors receive the same amount of Social Security benefit as everybody else. And that's not true. Social Security benefits are generated based on the top 35 years of their earning history. So the more average income you have made during the top 35, earning years, then the higher your Social Security income benefit will be. And it matters when you elect. So there are delayed retirement credits in Social Security, and the longer you delay, up to 70 is the latest you can delay, then you get 8% delayed retirement credits per year. So if you were getting 100% of your benefits at 67, if you had elected at 67, which is your full retirement age, and you decided, well, it's in my best interest in the planning that we have done and the forecast we have looked at to delay that until 70, and you can do that. Well, there's 3 years of delayed election. That's 24%. So 8% per year compound for 3 years. That's 24% greater paycheck than had you taken it at 67, certainly than if you had taken it at 62. But Mike, do you think that, what do most people do? Do they take it the earliest they can, or they do a judicious analysis so that they can see whether or not they can delay it and take home more money for the rest of their life? What do you think?
I would wonder how many people even know that it's possible, know about the compounded 8% per year, and make that calculation, because too many people, I think the answer is, people just say, the minute I can get it, check the box and give it to me. But look at what you're leaving on the table.
Truly, because once you elect, and then the benefits don't stay the same, because you have COLA, cost of living adjustment, based on the CPI calculations the government does on the inflation. So you get COLA increases based on inflation. So where we are today, it looks like, come another month or so here in October, where the government declares what that raise in Social Security will be. That could be 6, 7, 8, who knows, whatever inflation is at that time. That'll be a big pay raise for folks, more than they've had in a long time. Okay, here's another one. You ready? People think that taxes will remain flat during their retirement years, or that there will be the lowest taxes during their retirement years. It used to be that
based on the
thinking.
assumption that, oh, I'm retired, I'm not going to be making much money, so obviously my taxes will be less. But they're not focusing on the tax rate that, the government has to get taxes to pay their bills, and they're not, obviously known for not paying their bills too good.
Right. And if taxes go up and the amount of money that's in your deferred tax IRA, your traditional IRA, is going up, you have to take out bigger percentages to take that out.
Mm-hmm.
And it's growing in between there, and then the tax rate goes up. You're gonna be going up, and you didn't plan on that. So this is one of the biggest misconceptions we hear. So did you know that during 1960 and 1963, the current 24% tax bracket was actually 56?
Wow.
And that figure is 8% higher, than 2 times the same tax bracket. So imagine if this were the case today and you withdrew $10,000 to go on vacation for your family, the government would get $5,600 and you would be left with $4,400. How do you like that?
No good.
Yeah. So the taxes on that. Yeah. So you need to do everything you can to tackle that misconception that taxes will remain flat during your retirement. And again, that's why a smart tax review is part of our smart financial planning that we do for our clients here. So here's one more. You gotta help me here on time here, because there's a couple of goodies here. Most people assume they're just gonna die when they turn 90, so that they can plan to live that long. It's true. 90 years old is quite a common bogey for financial planning. We have a great aunt named Dixie, and she is just the most beautiful person inside and out. And she just turned 103.
Wow.
And
I think more and more people are doing that because you're eating better, you're staying active, your mind is staying active. And so maybe that needle is moving, right?
So maybe that, and medical care and advancements in technology has improved as well. Back in the day, you get some pneumonia or something, you'll die. These days, no, you stay in ICU for a while, but then you'll survive. So the example of I brought up Aunt Dixie is, I looked it up. She's of a special class. It's only, I believe it was 0.004% people on planet Earth ever reached that age.
Wow.
However, there was a Time magazine edition ages ago that said the person who will live to 140 years old has already been born. How do you like that? The person who will live to 140 years old has already been born.
Good night.
Yeah. So put it this way, we will more than likely live longer than we expect, and it will probably take more money than we expect to do that. Right.
Wow.
So
yes.
the CDC says that if both, and this is a really interesting one, if both spouses live to age 65, it's highly likely, very high percentage, that at least one of them is going to live to 90 years old, to be over 90 years old. So we need a plan for income and money and assets to last. Okay, so that's a big one there. And how are we doing on time?
I think that you probably can wrap up with your last couple points. I want to make sure that this is staying nice and concise for everyone, but I know that these are really important topics.
Okay. So last one here. People assume that they can handle their retirement planning themselves, don't they? Yep, a lot of them do. Spreadsheet mavens, do-it-yourselfers, they really enjoy getting 10 different newsletters. And then maybe trading their spouse's 401k themselves, that is really tough. So the technology has changed. That there's all these very large hedge funds and institutional accounts that have artificial intelligence that are trading that if a stock even goes up a penny, and because they have billions in there, they can do flash trades. How is the do-it-yourselfer trader going to be doing that? So And also if you pass away and you had been personally handling all your own retirement financial planning, all of a sudden your spouse has the responsibility of settling the affairs and taking care of them themselves. So we need to do everything we can to set both spouses, not just one spouse, but both spouses up for success during retirement. So that's transparency, honesty, getting a clear view of what's going on with the finances and how it's set up for success throughout their lives. And we believe the right way to do this would be to start working with someone, your fiduciary financial planner, like we are, while you're both still alive. You're still here on planet Earth. So we can establish a plan that will ensure that both of you are going to be taken care of for your golden years. Make sure you've got, no matter what happens, the market crashes, the economy goes down, one of you gets sick, one of you predeceases another, one of you needs long-term care, that in each of those boxes, you've done your best, you've done your planning, you've overcome the inertia, and you've checked those boxes and said, we have a solid plan and we can go to sleep at night knowing we've done our best job. So I encourage everyone who's listening out there, just know that there are some gotchas out here. And this is just a short list. There are some gotchas out there that can derail your retirement and you won't even see them coming. So you've got to do the planning, ask the right questions, get a criteria, get a checklist, meet with somebody who's a fiduciary, a financial planner, and go through these things and make sure that your plan is as strong as it can be.
So you can rest assured and sleep well at night and all those cliches, but to know that your financial portfolio is dialed in as well as possible for your specific needs.
Well said. Well said, Mike.
Excellent. Well, Merrit, wrap us up with what's the best way people can learn more about your firm, Momentum Financial and Insurance Services, as well as reach out and maybe set up a time to get to know you and see what you can do for them.
Right. Really easy. First and most obvious approach is call us at our phone number, 858-521-9700. That's 858-521-9700. You can go to Momentum FS Group, like FrankSamGroup.com, or you can type in my name, Merrit, Merrit, Strunk, and Momentum Financial, and you will find me on the web.
Excellent. Well, Merrit, thank you so much for coming back on. It's been a real pleasure talking with you today about these super important topics.
It's such a privilege to be here, Mike. Thank you for having me again. I appreciate it.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.